You've probably booked a trip recently and noticed prices just creeping up everywhere.
Oh yeah, absolutely everywhere.
Right. But have you ever stopped to wonder how the massive machine behind your booking is actually performing? Because last quarter, Expedia faced this massive geopolitical shock that basically froze international travel across Europe and Asia.
Yeah, and almost at the exact same time, they were dealing with these localized travel advisories that wiped out their domestic momentum right here in the U.S.
Exactly. So by all traditional metrics, this should have been a disastrous quarter. But despite taking a real measurable hit to their growth right in the middle of the quarter, they somehow posted their highest profit margins in 15 years.
Which is wild.
Right. And they grew their earnings by nearly 400%.
Yeah.
So today we are looking at the invisible plumbing that actually made that possible.
Because it's completely counterintuitive if you're only looking at the consumer side of the travel industry. You see a headline about global tensions and you just assume nobody's flying.
Right. You think the booking platforms are just bleeding cash.
Exactly.
Yeah.
But that completely ignores the underlying financial machinery of a platform operating at this scale. And, the financial health of that machinery tells us a huge amount, not just about this specific company, but about the whole state of global consumer spending.
And the shifting economics of customer acquisition, too.
Yeah, and really the future of how artificial intelligence is just quietly rewiring the whole transaction layer of the internet.
And that is our exact mission for today's deep dive. Welcome back to Talk Tickers, where we break down corporate earnings calls for you, the retail investor. Today, we are completely focused on Expedia Group, Inc., ticker symbol EXPE.
We're looking at the Q1 2026 earnings call specifically.
Right. So we'll be acting as your financial translators today. We're going to use our usual data-forward, plain language approach. We want to dissect the headline numbers, uncover the real story driving those metrics, and analyze management's guidance.
And of course, deliver an opinionated, actionable bottom line on what this actually means if you're holding the stock.
So, okay, let's unpack this. Let's get right into those headline numbers because they are a historic quarter for margins.
The scale they're operating at is just staggering.
It really is. So Q1 2026 gross bookings hit $35.5 billion. That's a 13% increase year over year. Think about that volume for a second.
$35.5 billion in 90 days.
Right, in hotel nights, flights, and rental cars. And that translates to top-line revenue of $3.4 billion, which is up 15%. But the metric that really demands our attention is the adjusted EPS, the earnings per share. It came in at $1.96.
Which is an incredible 4 times growth.
4 times. And then there's the adjusted EBITDA, which was $542 million. That represents a 15.8% margin.
Yeah, and we really need to pause on that 15.8% margin because expanding that margin by nearly 600 basis points or 6 full points year over year, that is a defining achievement of this transcript.
Because for a mature tech company, getting that kind of leverage is, it's really hard, right?
It's incredibly difficult. You have a legacy tech stack, thousands of employees, massive fixed costs.
Yeah.
So to suddenly wring out an extra 6% of profitability from your revenue, it means you've decoupled your top line growth from your operating expenses.
So they drove revenue up 15%, but they didn't have to raise their undersigned costs by 15% to do it.
Exactly. It's their highest Q1 margin in 15 years.
It's like upgrading your car to get drastically more miles per gallon, right? You're not just driving faster, you're doing it way more efficiently.
That's a perfect analogy. And that efficiency drops straight to the bottom line, which is why they have so much excess cash right now.
Which brings us to the shareholder yield. The capital return here is aggressive. In Q1 alone, they used $700 million to buy back 3.3 million shares at an average of $212.
Yeah, and the cumulative effect of that is massive.
Right, because since 2022, they've reduced their overall share count by 24%. And on top of that, they just approved a new $5 billion share repurchase program.
And that matters so much to an investor. Buying back 24% of the company drastically increases the value of the remaining shares.
Okay, but wait. Let me push back on this a little bit. If they are growing revenue 15% and taking in $35.5 billion in bookings, why spend $5 billion on their own stock instead of, acquiring a competitor or building new tech? Are they just out of growth ideas?
It's a fair question, and it's the exact debate happening on Wall Street right now. But the thing is, they are still investing heavily.
Okay.
Particularly in B2B and AI. They just have so much free cash flow, $4.1 billion over the trailing 12 months, that they can afford to do both. They're funding their internal growth while simultaneously buying back stock because they clearly believe it's undervalued.
So it's not a lack of imagination, it's just a surplus of cash.
Right, exactly. Which actually leads right into the story behind how they achieve these numbers.
Yeah.
Because it wasn't a smooth quarter at all.
No, it was a total roller coaster. If you look at the timeline from the call, January and February were incredibly strong. They were carrying all this momentum from Q4 of 2025.
Yeah, the strongest start to a year they've had in a while.
But then March hit a wall.
A brick wall. And the transcript is very clear about the geopolitical impact here. The escalating conflict in the Middle East caused elevated cancellations across Europe and Asia.
Now, just to clarify, they aren't sending a ton of people to the Middle East, right?
Right, it's less than 2% of their total bookings.
Yeah.
But the uncertainty, the airspace closures, the rising fuel surcharges, it creates hesitation.
So a traveler in London planning a trip to Asia suddenly gets nervous and cancels.
Exactly. That impacts their B2B partners internationally. And then, at the same time, travel advisories in Mexico hurt domestic U.S. consumer travel.
Because Mexico is huge for American spring break travel.
Massive.
Yeah.
So you combine the international hesitation with the localized U.S. demand drop, and that volatility cost them about 2 full points of growth in the quarter.
Wow.
But the good news is the cancellations stabilized and rebounded in April.
Yeah, and despite that hit, the consumer brands, the B2C side of the house, still had a resurgence. B2C bookings grew 10% to $24.8 billion.
Which is the fastest pace in 12 quarters, outside of the weird COVID rebound years.
Right, and a big part of that is Vrbo. They mentioned that Vrbo vacation rentals hit an annualized run rate of $1 billion booked directly on the main Expedia app.
And the convergence is huge. They're putting vacation rentals right next to traditional hotels in the search results.
Which is so much easier for the consumer. But what really caught my eye was that over a third of Vrbo bookings came from supplier-funded promotions.
Oh, this is a masterclass in margin protection.
Right, because normally if Expedia wants to offer a discount to win a customer, they have to eat the cost, which hurts their EBITDA.
But with supplier-funded promotions, the algorithm basically goes to the property manager and says, hey, if you take a 10% cut to your payout, we'll bump you to page 1 as a special deal.
So the property manager absorbs the cost of the discount, not Expedia.
Exactly. The consumer gets a deal, the supplier gets visibility, and Expedia still collects its full platform fee.
It's crowdsourcing their promotional budget. That's amazing. But B2C is only part of it. Let's shift to the B2B segment, because this is just a juggernaut.
It really is. The B2B segment grew a massive 22%, bringing in $10.7 billion.
So for anyone listening who isn't familiar, how exactly does Expedia's B2B work?
Basically, Expedia powers the travel booking engines for other companies. They're the invisible plumbing. So when you use your credit card points portal to book a hotel, or you book a hotel through an airline's website, that's often Expedia's API and inventory running in the background.
They're just white labeling their massive supply network.
Exactly. And they had 2 major catalysts this quarter, an exclusive partnership with Bank of Montreal Air Miles, and they became the exclusive hotel partner for Uber.
Okay, here's where it gets really interesting, and I have to push back again. Partnering with Uber, how does that work? Are people really booking a 5-star resort while waiting in the back of an Uber for their ride to the grocery store? I mean, the use case just seems bizarre to me.
You're not the only one. An analyst challenged the CEO, Ariane Gorin, on that exact point. But you have to look at it from Uber's perspective.
Yeah.
They have this massive user base with credit cards already on file.
Right, they've already paid the customer acquisition cost.
Exactly. So Uber wants to monetize that captive audience. They want to be a super app, but they can't build a global travel agency from scratch.
So they just plug Expedia in.
Right. And as for the use case, think about a corporate traveler whose meeting gets moved and they need a hotel while they're in the Uber heading downtown. Or someone using Uber in a new city who decides to book a weekend trip.
Okay, so it's that transit mindset.
Yes. Even if the conversion rate is tiny, applying it to Uber's massive daily active user base results in hundreds of millions in incremental bookings.
And Expedia gets access to all that traffic without paying Google a single cent in ad spend.
Precisely. It's brilliant.
Okay, so that perfectly transitions us to section 3, the secret sauce. Because growing consumer bookings by 10% is great, but doing it while cutting direct sales and marketing expenses by 7%, I mean, that is sorcery. How did they do it?
The answer is AI. It's acting as this massive operational engine for them.
Right. They aren't just using AI as a buzzword. It's actively driving that historic margin expansion. They laid out 4 specific pillars of their AI strategy in the transcript.
Yeah, let's break those down because this is where the unit economics are actually changing.
Okay, pillar 1 is the traveler experience. They're using AI conversational experiences and AI filters, and it's driving record conversion rates and attach rates, like adding insurance.
Because instead of a clunky sidebar with 50 checkboxes, the AI understands natural language. It curates the inventory based on context.
So it knows a family going to Orlando wants different things than a solo corporate traveler in Manhattan.
Right. It removed the friction so people just click book instead of bouncing to another site.
Pillar 2 is supply advantage. AI helps them onboard new properties 10% faster. They have 3.7 million properties now, and 800,000 are exclusive.
This used to be a huge human bottleneck, uploading photos, rating descriptions in multiple languages. Now an LLM scans the photos, tags the amenities, and writes the SEO descriptions instantly.
Which means they can scale their inventory way faster.
Exactly.
Then there's pillar 3, customer service. This one is crazy. They handle 250 million interactions a year, and over 30% are now powered entirely by AI.
And when a human is needed, it reduces human agent onboarding time by an astonishing 60%.
How does it help the human agent so much?
Because of the hybrid handoff. The AI auto-summarizes the issue, translates it, pulls up the airline policies, and drafts a resolution. The human just manages the workflow instead of spending 10 minutes asking for reference numbers.
Wow, that's a massive cost saver. And finally, pillar 4, marketing and traffic. They're using ChatGPT ads, Claude integration, and answer engine optimization.
Or AEO, yeah. They explicitly said AEO is their fastest growing channel right now.
Because instead of typing cheap hotels into Google and looking at blue links, people are asking Claude to plan a 5-day itinerary.
And Expedia is making sure the hotels recommended in that itinerary are hyperlinked directly to their checkout page.
Okay, so they're positioning themselves to be the trusted transactional layer for the AI era. But wait, AI isn't free.
No, it's very expensive.
Right. Computing power, NVIDIA GPUs running these models, it costs a fortune. Doesn't this threaten their beautiful new 15.8% profit margins?
It absolutely does. And the CFO, Scott Schenkel, was very upfront about this. He explicitly noted that token costs, which is the cost of running these AI queries, are going to go up in the second half of the year.
As they add more skills and handle more traffic.
Exactly. Every time a consumer asks the chatbot a question, it costs a fraction of a cent. And that's going to put upward pressure on their costs.
Which perfectly explains why management might be playing it safe with their future outlook. Let's get into section 4, management guidance.
Yeah, the guidance was definitely the point of friction on the call.
For Q2 2026, they expect gross bookings growth of 7% to 9%, revenue growth of 9% to 11%, and EBITDA margins to be up another 50 to 100 basis points.
Which is solid, even if it's a slight deceleration from Q1. But the full year is where things get interesting.
Right, because despite absolutely crushing Q1, management reiterated they maintained their previous full-year outlook. Bookings up 6-8%, revenue up 6-9%, and margins up 125 basis points.
Though they did say they expect to hit the high end of those ranges.
So what does this all mean? If you blow past Q1 expectations, why not raise the forecast for the rest of the year? Are they hiding bad news?
It's really about the psychology of corporate guidance. Management cited 2 main reasons to hold steady. The first is macro volatility.
Because of what happened in March.
Exactly. March proved that geopolitical events and rising airfares driven by fuel costs can just swing demand unpredictably. They're pricing in the probability of more shocks.
Okay, that makes sense. What's the second reason?
The second reason is what Wall Street calls lapping the cuts.
Right.
The massive margin expansion in Q1 looked so dramatic because they were comparing it to a time before they enacted massive corporate cost cuts last year.
Oh, I see. So they were comparing a newly lean operation against an older, bloated one.
Exactly. But in the second half of 2026, they'll be comparing themselves to quarters where those cuts were already in place.
The easy margin wins are behind them. Now they have to fight for every basis point while paying for those rising AI token costs.
Precisely. And they'll be doing it with a new CFO. Scott Schenkel is departing, having set up this strong foundation, and he's handing the reins to Derek Anderson.
Okay, so with all the data, the macro stories, and the guidance unpacked, it's time for the outro. The bottom line. What are the actionable takeaways for the listener?
I'd say there are 3 critical points you need to remember. Number 1, Expedia's B2B segment is a massive, somewhat hidden growth engine. 22% growth, securing deals like Uber. It's a huge catalyst.
Number 2, they achieved historic margin expansion, 15.8% EBITDA, by effectively leveraging AI to lower marketing and customer service costs.
And number 3, Management is executing massive share buybacks. A $5 billion authorization shows extreme confidence in their cash flow, even with volatile macro environments.
So talk ticker style, what is your verdict?
This earnings call reads as a strongly bullish signal for long-term holders. The company has proven it can grow its top line by 15% while ruthlessly expanding its bottom line. I mean, EPS was up 4x.
It's a highly efficient cash-generating machine.
Exactly. The reluctance to raise full-year guidance seems rooted in prudent caution regarding geopolitics and lapping those cost cuts, rather than any underlying business weakness.
But as always, you have to weigh these insights against your own portfolio strategy. You have to understand your own risk tolerance regarding global macro events, because the travel industry is always vulnerable to the news cycle.
It absolutely is.
Which leaves us with one final lingering question to ponder. We talked a lot about answer engine optimization.
Right, the shift from searching to asking.
If Expedia's fastest growing traffic channel is now AEO rather than traditional SEO, how long before typing a destination into a search bar feels as outdated as calling a travel agent?
It's going to happen faster than people think.
And when that happens, who truly owns the customer? Is it the AI that suggests the trip or the platform that actually fulfills it? Something to mull over the next time you ask an algorithm to book your weekend getaway?